This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
I want to move on, though, to our post-game chart deck. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads, just above Jim Bianco's picture. Patrick, the chart deck is titled, Is There More Downside to the Markets? First three slides look to be the major equity indices. What's going on here?
Right. So for at least this week, I wanted to reference that 50-day and the 200-day exponential moving averages. And just as a reference point to where we are in the markets, one of the things that we've seen during the bull phase was that every time the market would dip down toward the moving average, just consider it sort of like a midpoint of an advance, it was bought on dip very aggressively and quickly, and it spurred the next legs of the market rallies higher. We have seen a dynamic shift in the last 2 months in the way the equity markets are behaving. They have become very distributive, and no rallies are sticking, and all rallies are failing. And these, while this in itself doesn't guarantee another leg lower, it does show that the price action is generally distributive, very weak, and therefore it does make the market continue to be quite vulnerable. It's interesting that the S&P 500 is consolidating right along some fib zones, which conveniently is where that 200-day exponential moving average is. Traditionally, some of the bigger market corrections, think of like the Christmas massacre of 2018, when the markets got below those 200-day moving averages is when the selling really accelerated. And so while I'm not trying to predict that this drop is imminent, and to highlight the vulnerability of the market at this stage, because if anything spurs a sell-off that gets under 4,400 on the S&P, it could really start to feed on itself and create a mini liquidity event that could have us testing even 4,000 on the downside within a week or two. Let's see whether the bulls can put it together. Also just highlighting on the NASDAQ and the Russell, both of them are not only below those moving averages, but continue to be rather weak on a relative basis. And so this is just a very weak market. The breadth continues to be very poor. And overall, I think it's important to be very cautious in this market environment.
Well, Patrick, I'll be the first to admit that I don't know what to make of this market environment. As I think through everything I know from the old normal, how markets used to work when economic fundamentals were the primary determinant of market direction, I would say the market is shockingly still overvalued and overdue for a crash, and I wouldn't be worried about down to 4,000. I'd be thinking about down to 2,500. But, every time I've had that kind of view in the last 10 years, I've been wrong. And it just hasn't worked out that way. So I don't want to make a directional call. I would say there's lots of room, though, if things get going for a bear market. We've got a whole generation of professionals who don't know or haven't ever experienced a bear market, and I think it could get really interesting. Let's move on to gold futures on page 5. What's happening here?
Well, I mean, you summarize gold very well in the market wrap in the sense that it's a very bullish breakout. But what I really like to do is just zoom right out. This is a weekly chart, and so that's a 50-week moving average that the market was hovering on. The key was we had a very strong gold bull market from 2019 to 2020. And after an extraordinary run that saw gold almost double in that time frame, we've spent more or less well over a year just backfilling and consolidating the move, whether you want to call that some sort of a triangle formation or a wedge. Bottom line is that the market has been winding up and unwinding the overbought state that it was in. With this breakout, if the bulls, and the key was exactly like you're saying, if the bulls can actually hold this breakout, this could potentially be the beginning of the first leg of a trend move that may come in play. And when you really look at the scope of the length and duration of the average move in gold over the last couple of years when it breaks out, this is really just the beginning. And one of the things I'm going to be watching here is whether we see the characteristics of every time there's a sell-off, whether the bulls keep buying dips, whether the price continues to be well defended, are all the types of characteristics that will start to exhibit that a potential new trend move is underway.
Well, Patrick, I've had a question for you I've been thinking about all week, which is if we zoom out even farther, if you imagine seeing all the way back to 2011 on this chart, the price goes back up to right about where we are now in the mid-1900s. It really looks to me like the price action from the summer of 2011 through the summer of 2020 could be the cup in a cup and handle formation. The thing is, I can't decide if what's happened since the summer of 2020 really looks like a handle. It seems like it's awfully stretched out to be a handle. What do you think? Could this be a cup and handle? And if so, what would the implications be?
Well, a cup and handle formation is typically seen after an extended bottoming formation. To me, while the pattern does exhibit that, where you have a long rounding basing formation, that pattern would appear, I think that it was really just a very big and extended correction, a bear market correction of a very overextended gold market. Bottom line, though, is that overall gold has been behaving very well if you zoom out on weekly and monthly charts. The problem that gold has had is in the last year, while everything else was making money, gold wasn't. And therefore, the sentiment toward the space just wasn't strong. But after this type of a correction, inevitably, every market has a cycle, and will be interesting if this is the beginning of a new one for gold.
Let's move on to fixed income markets. The next three slides, we're looking at Treasury bond yields, investment grade, and high yield.
Right. So what I wanted to just simply highlight is obviously the jump in yields has been driving the entire credit market, and so as we have the 2% level being tested on the 10-year, and obviously 5 and 2 years have been just ripping on the upside. This has stressed all of the markets. Now, one of the things that we highlighted weeks ago was the investment grade corporate bond market using the LQD ETF, but just highlighting simply how weak the investment grade corporate bond market continues to be. Again, this is an incredibly bearish and ugly looking chart, and the selling seems relentless and doesn't want to quit. But what's interesting is over the last month was the first time in a while that we've started to see the credit spreads start to wobble. Like the first part of the drop in junk bonds and in investment grade bonds was really just correlation to treasury yields. As the entire interest rate market was moving, they were adjusting and going down. But we're now finally seeing, a 1 year spike highs on both high yield corporate bond credit spreads as well as investment grade credit spreads, which means that the stock market is starting to get a little bit nervous and pricing in some of that risk premium. It'll be really interesting to see if this trend continues. And certainly you have to think that if we see corporate bonds start to really get hammered, that the stock market is going to start carrying at some point. And that certainly could be a catalyst for further weakness in the stock market if this trend continues.
Listeners, if you enjoy Patrick's chart decks, be sure to check out a free trial of Patrick's service, Big Picture Trading. You can get these chart decks every single day of the week. Information's on page 9 or at bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.